this is psychological. You feel like you're in control when you have a lot of data and you do more work. But sometimes you've got to let that need for control go and say, look, this isn't helping me as an investor. It's making me feel more secure, more confident, but it's really doing nothing for my investment.
In this video, Professor Aswath Damodaran, a renowned authority in finance and investment, provides invaluable wisdom on navigating the complexities of investment strategies. He emphasizes the importance of striking a balance between simplicity and detailed analysis, while shedding light on the psychological aspects of investing. Learn how to embrace uncertainty through statistical tools like Monte Carlo simulation, gaining a better understanding of risk assessment and potential outcomes. Professor Damodaran's expertise will empower you to make more informed investment decisions and avoid common pitfalls in the dynamic world of finance.
I think you have to keep it simple, but not simplistic. What I mean by that is you got to add the detail you need to add. In the case of NVIDIA, for instance, you need to bring in the AI business explicitly. I generally try to avoid bringing in detail that I don't need, where I have no information. But if you have information that you need to bring in investing, you need to bring it in. So if you're being simplistic and saying, look, I'm going to use the PE ratio, it's a simple number, I can't deal with this other stuff, it's too complicated, you're being simplistic, not simple. So I think you need to bring in as much detail as you need to make an investment and nothing more. The problem I have with a lot of investors is they drown in detail, especially as they get more technically proficient. The more access they have to data, it's easy to get drowned in the details and lose perspective. So you constantly have to step back and say, does it make sense for me to add that layer of detail? Does it make me a better investor? Or am I just doing this because it makes me feel better? A lot of this is psychological. You feel like you're in control when you have a lot of data and you do more work. But sometimes you've got to let that need for control go and say, look, this isn't helping me as an investor. It's making me feel more secure, more confident, but it's really doing nothing for my investment. I'll make a prediction. You take any company, you come up with a low value, it's worth nothing. There's some scenario where the company's worth nothing, and high value, it's worth a lot. So what have you learned with your best case, worst case, other than covering your rear end? You know who likes low, high numbers? Investment bankers. Why? Because that way they're covered no matter what happens. So I'm not saying don't explore scenarios, don't look at the range, but ultimately you've got to accept the reality that there is a price and you've got to have a base value, whether it comes from a distribution or a single value. You have to make a decision, buy or sell. There is no strong buy, weak buy, really weak buy. As far as I know, when I put in a buy order for 10,000 shares, it is either a buy or not a buy. So I think there's a lot of Weasley stuff in investing where people do things because they want to be right no matter what. And that's a luxury you have when you're an appraiser or an investment banker, when it's not your own money. When it's your own money, you either have to buy or not, and you have to make a decision based on a price and a value. So I don't disagree with the fact that value is a distribution. I just don't see the point of trying to come up with a low or a high unless you have this rule that you will not buy a stock unless the price is below your lowest value, in which case I'll make a prediction. You're going to be in cash for the rest of your life.
For a long time.
The low high was the only technique we could use 40 years ago because in a sense, valuation was, you valued a company, then to do the low, you had to change all the inputs to your worst case scenarios, and a high, you made them the best case scenarios. To begin with, the world doesn't operate in that kind of scenario. The kinds of scenarios where your revenue growth is lowest might also be the scenarios where the economy is doing badly and interest rates are much lower. So in other words, you very seldom get where every input goes to its worst case or every input goes to its best case. And 40 years ago, you said, what choice do I have? I can't be doing hundreds of valuations with all these different combinations. Now, one of the techniques I use in valuation, and it used to be a lot of work, is a Monte Carlo simulation, where I accept the reality. When you estimate growth, you're estimating it with error. So if you ask me, what's a growth rate in NVIDIA, I could give you a number, and then I'm going to wring my hands and say, you know what, I could be wrong. And you know what? You should put me on the spot and say, tell me how wrong you could be. Give me a distribution for growth. It's in a way a much more complete way of dealing with the fact that we're uncertain about our numbers. We bring in the uncertainty into the inputs. And in a simulation, you essentially run valuations over and over, drawing from your distributions. You get a distribution of value. That distribution of value will deliver what you wanted, the low and the high. But it'll also give you the 10th and the 90th percentile, the 20th and the 80th. It's much more informative because unlike NVIDIA, most companies fall between the low and the high. But I can tell you, for instance, that Apple is at the 73rd percentile of my values. In other words, there's a 27% chance it's undervalued and a 73% chance it's overvalued. It adds layers of nuance to this uncertainty assessment. You couldn't have done it 40 years ago, but today you can have an add-on to Excel. You can take any valuation you've done and make it into a simulation with almost no work. But it does require that you go back and review basic statistics on distributions and parameters. But that's something that I think all investors need to do, because uncertainty is not a bug in investing. It's a feature of investing. Rather than hide from it, we should face up to it. And to face up to it, the tool that's best suited to facing up to uncertainty is statistics, and we underutilize it. All distributions have expected values, right? So the 6 to 16 is your range. I'm going to push you on it. You have a range of 6 to 16. Give me more information. Is there a peak? In other words, is there a middle number that you think is more likely? You might say, look, I'm completely diffuse in statistics, we call these priors. I have no idea where it's going to. That's called a uniform distribution. Your numbers could fall anywhere from 6 to 16. Your expected value then will be 11%. But if you say, look, I think it's more likely that it's 8 or 9%, that's where the bulk is. But there is this chance that Apple services and Apple iCar could take off. That's a 16%. And there's a chance that the next iPhone upgrade could collapse, which gives me the 6%. That's a distribution. The peak is around the 8 or 9%. There's a tail towards a 16 and a tail towards a 6. But I would give you an expected value that's closer to 8 to 9% than the 11%. That's what distributions force you to do. They force you to go beyond saying, this is my low number, this is my high number, and saying, okay, tell me more. Tell me what you think about this company. And guess what? It gives you guidance as you look at the data. For me, the biggest problem we face today is we're drowning, I won't say in information, because information is too strong a word. We're drowning in data, qualitative data, quantitative data, opinions, estimates. What this gives you is a sense of taking that data and saying, I want to use this data to get a better sense of where between 6 and 16 my base case should be. Is it more likely to be closer to the 6 or closer to the 16? That is useful assessment if you think about investing in a company. We love uniform distributions because your expected value is in the middle. But, I disagree with Nassim Taleb in many points, but one of the points he emphasizes over and over, the world is not a bell curve. As we discovered with COVID, you get outcomes that are extreme. And in a sense, if you don't model them into your process, you're constantly going to be surprised by these outliers, when in fact, they should be part of the process. With NVIDIA, the reason I continue to hold NVIDIA, even though I found it overvalued, is I do think that in the distribution, the likelihood of an extreme positive tail is greater than an extreme negative tail. Why? Because of the story you tell about NVIDIA. This is an opportunistic company. 3 times in the last decade, they found a market ahead of time, the gaming market, the crypto market, now the AI market. They jumped in. 3rd time, you can't say they're lucky. There's something systematic they're doing. So the tail in this distribution comes to the fact is, hey, we don't know what the next 10 years will deliver in terms of new markets, but NVIDIA is likely to be a lead player in those markets given their history. That's a tail in the distribution. Those tails can affect your investing decisions. You might actually buy a company that's close to fairly valued if the tail of the distribution is an extreme. Those are the 10 baggers, right? So if you want to use the verbiage of traditional value investments, I want a 10 bagger in my portfolio. The way you do it is by finding those big tails. And to look for those, you got to bring it into the data. This is to prevent that most dangerous of all emotions in investing, which is regret, right? We've all had it. I wish I hadn't sold it. It's not the regret itself that's a problem. It's a consequence of regret, because what happens when you have regret is it alters the way you invest. So I'll
Of
give you an
course.
example. Let's say you sold Nvidia at 410, it goes to, it goes to 800. Your regret is, why did I sell? There's nothing you can do about Nvidia, but here's what's going to happen. The next time you have a stock that quadruples in your portfolio, you're going to say, look, I remember what happened with Nvidia. I'm going to hold on to this stock. You're, in a sense, eating away at the heart of your investment philosophy because regret is making you do it. So
Yep.
I don't like regret in my investing because it makes me do things I should not be doing that are inconsistent with the way I think about investing. So I would feel okay either way. Either way, I'm going to pat myself in the back. Job well done on half my holding. And for that reason, I think sometimes making this a 0-1 decision, being rigid in investing, can actually get into trouble in the long term, because you have these rules that you're so rigid on that you never break them. And then you end up psychologically so mixed up as a consequence, it ends up doing more damage than good in the long term.